All right, good days. Welcome to today's training section. Now, in this training session, we'll be talking about trading strategies. If you're trading cryptocurrency, you're trading forex, stock, whatever, you need to have a trading strategy. So basically, this is called trading with strategies that is applicable to any type of trading. But we're focusing more on the crypto aspect of it. But these techniques also applicable. Now, if you are trading cryptocurrency without a strategy, the chance of you losing your money is almost close to 95 or 98%. So you need to have a strategy. So in this training, we'll talk about 4 basic type of what trading what strategy. So let's get there. Now, if you're trading cryptocurrency or forex or stock, it is very important to have a plan. When I say have a plan, you don't enter the market without having what a plan. And that plan is what you call trading what now? Strategy. So you enter the market with a plan, enter the market with a trading strategy. So you need to ask yourself, which trading strategy do you want to enter the market into? So trading strategy number 1 we're going to consider is called the dollar cost average, DCA. Now, the dollar cost average is a kind of a long-term trading technique. It is actually the easiest trading strategy. For the fact that you know how to buy, how to sell, then you can involve in this type of trading or strategy. So it is more like an investment, because it's long-term. So what do you do with dollar trading average? So the key point in dollar trading, dollar cost average, it's a long-term project. You research the project, you use fundamentals, you use tokenomics, there's no FOMO. So these are the key points in dollar cost average. Repeat the key points again. You research the project, you use fundamentals, you use tokenomics, and there's no FOMO. Now, what do you do in dollar cost averaging? Let's say, for example, now you want to invest in Bitcoin. You use your coin market cap or a coin gecko to check the tokenomics, talking about the security supply, maximum supply. You check the all-time high, you check the all-time low. You check about what people are saying about that project. Look at people sponsoring that project. Look about the use case of that particular cryptocurrency project. So once you decide that you are okay with this project, now what do you do? So apply the dollar cost average. Let's say, for example, you have $1,000 to invest in that project. You don't put the $1,000 inside that market at that particular time. You can decide to divide that $1,000 by 5. That means that $1,000 by 5, you are spending at $200. So that $200 you can decide to spread within a period of 1 month. Month 1, you put $200. Month 2, you put $200. Month 3, you put $200. Now, you might be asking yourself, what is the advantage of this dollar cost averaging? You know that cryptocurrencies are very volatile. Therefore, means that the price can fluctuate. So the price of cryptocurrency in month 1 cannot be seen as price of cryptocurrency in month 2. So let's say in month 1 you bought at $45,000 and the price drops to around $20,000. So in month 2, when you're buying in month 2, you are buying more quantity of Bitcoin without the same amount of price. I know if you get what I'm saying now. So in month 3, let's say in month 3, the price goes to around $30,000. Remember, in month 1, you've already done some loss before. From month 1 to month 2, you've already done some loss because why? It was you bought at $45,000 and it dropped down to $20,000. But you bought some quantity again, which is about $200. So the price now move over to $35,000 in month 3. What does that say? If you do your plus minus, you find that you'll not be losing more compared to when you just focus on what you did at month 1. So it did continuously. So the essence of the idea of dollar cost average means that you are spreading your money. You are buying at different price. You are buying at different price. You are buying at different time interval. So if there's a drop in price or there's a increase in price, you tend to balance it because you are buying at different intervals. So that is one of the easiest, the number 1 technique when it comes to trading. So this trading technique is called dollar cost average. What do I mean? You spread your amount you want to invest in a particular project at different duration. Let's say, for example, again, I said if you have $1,000 to buy a particular cryptocurrency project, instead of buying that lump sum in just 1 month, divide by 5, or it depends on you can divide by 10, and you spread it accordingly. So if I divide by 5, I can be spending $200 every month. If I divide by 10, I can decide to be spending $100 every month, or it depends on any division you want to. So that's what dollar cost average is all about. Now the next trade technique we'll be looking at is called swing trading. Swing trading is called the next daily trading. Now, as the word implies, swing is a short and medium term trading, usually lasts between days or weeks. So in swing trading, you use what you know as fundamental technical analysis. When we talk about technical analysis, we're talking about charts, indicators. These are talk about technical analysis. So in swing trading, you don't look at long-term trading as considered like the dollar cost average. You are looking within, let's say, days or weeks. Let's say, for example, you do your analysis, find out that this project is going to increase over time. So you enter that particular project, You buy at a lower price, then exit that project when you've already taken out for your profit. So that's what swing trade is all about. Why do we call it swing trade? It does not last long. You move from one project to another. Is it clear? So that's what swing trade. So the key terms in swing trading is that it's a one-day trading. Use one-day trading chart. And if you want to study for swing trading, you just consider a one-day trading chart. If you go to any of your trading sites or exchange, you have the one-day trading chart, you have the 1 month, you have the 1 year, 5 minutes, 10 and also. So in swing trading, you focus on just one-day trading chart. Now, another thing you need to understand is swing trading, it consumes more time compared to what you're talking about, dollar cost, what average, what trading. Trading techniques number 3 is called breakout trading. Breakout trading. Now, in breakout trading, you are trying to capture a breakout price region. When I say breakout price region, let's say, for example, the price of a particular coin has been dropping. So you're looking for a region whereby that particular price of that coin will go up. That's called the breakout region. So this is shorter. It's a shorter time trading as compared to swing trading. So a shorter time trade compared to swing trading. So the aim, like I said, is to cash out the breakout price region. It uses TA. TA stands for technical analysis and charts. Use indicators. Then for the breakout time trading, the time frame usually 24 hours, 8 hours, or 4 hours, 24 hours maximum. So what are you doing in the breakout trading? You follow the trend, look at the price pattern, follow the trend, and look at a region where there will be what? A breakout in price. So that's what you are targeting. So when you target that region, you execute your trade. You execute your trade around that region. Let's say, for example, you are looking at the chart. There's so much losses, and you believe that from a period of time, there'll be an increase in price, that breakout region. So you buy before that period of time for you to make profit. So that's why it's called breakout trading. So the fourth trading strategy we are going to look now, which is the final for this, the fourth trading strategy we are going to look at now. Okay, fourth trading strategy we're going to look at, which will be the last for this session, is called scalping. Scalping is also called intraday trading because it's used the shortest, it is using the shortest trading time, usually 5 to 10 minutes. So when we talk about scalping, in fact, this is the most tedious form of trading. It's the most tedious and also the most lucrative form of trading to some extent. So in scalping, what you just look like, you use technical analysis, you use charts, it requires lots of time, short-term profits. You're not looking at for a breakout point. You just study the trend. You study the trend, you use your chart, you use your indicator. You see when the price is going to drop and you see when the price is going to increase. In this kind of trade, sometimes you use your stop loss and you take your profits. So this one involves a lot of technical analysis, and it requires a lot of time. In fact, if you have to do scalping trading, then you have to go into that trading full time. Any other type of trading might not be in full time, but in scalping, you have to go into full time because it requires a lot of time and a lot of technical analysis. So these are the four basic trading strategy. First of all, we'll talk about the dollar cost average. Dollar cost average, what I say, you spread your money, break evenly, you spread your money across to buy a different time interval. Then number 2, we'll talk about the swing trade. The swing trade usually lasts between days and weeks, so it is take more time as compared to dollar cost average. They talk about the breakout trading technique. In the breakout trade technique, you are looking at for a breakout point. So breakout technique takes lesser time as compared to the swing trading. Then finally talk about the scalping. The scalping takes between 5 to 10 minutes. You use technical analysis, use chart, and requires a lot of time. So these are the 4 basic trading techniques every trader should know. So remember, before you get into a trading, you should have a plan. And that plan talk about applying a particular trading technique. See you in the next session.